Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is October 30th, 2023. Got a lot of data coming out this week. We got the Fed meeting on Tuesday and Wednesday will be their interest rate decision if they make one. And then on Friday, we get the October non-farm payroll jobs number, and we'll see if there's any revision from the previous blowout number for September. We also get a lot of corporate earnings this week, but let's go ahead and take a look at last week and the week to come.
Okay, let's go over the equity market in the form of the chart of the S&P 500. As you can see, we are in protect mode, and we've been in protect mode since August 15th of this year. Now, I added the 200-day moving average line, and right now it's sitting at 42.40 as of Friday. We don't trade on moving averages, but there are some firms out there that do, so it's kind of nice to get a feel for it because you may hear about it on social media or on the news. But let's take a look at our support and resistance zones for this chart. Last week, we were sitting literally right on the 200-day moving average and right on the support zone at the 42.40 level. Well, guess what? This week, the S&P 500 sold off, and we sold off right to the bottom of the support zone. And so that's kind of why these are key, because they do give you kind of a general area of where these markets can tend to trade to. Right now, the futures are up for this morning, so we can probably anticipate that we might trade up into the support zone, and maybe we'll get a little rally here over the next week or two because we are a little oversold. But the overall trend is lower lows and lower highs, so the trend is negative, and so we will remain in protect mode. All right, here's the chart of the bonds, okay, in the form of the U.S. Aggregate Bond Index, and we went to protect mode in May 17th. And we've been in protect mode for a long time here. And as you can see, yield started to go up. So the price is the inverse and it went down. And really the ag has been down about 5% since that moment. So we are in protect mode. So we're looking for other investments on the bond side, saying extremely short or completely out of bonds right now and waiting for a better day to get back into bonds. All right, let's go over the top three market headlines from last week. The U.S. stock index failed to get much lift from earnings season and a strong quarterly GDP report, as the S&P 500, NASDAQ, and the Dow each fell more than 2% for the week. It was a sixth negative week out of the past 8 for the S&P 500, but we did have some defensive areas in the form of bonds and gold that were slightly up for the week. All right, but let's talk about what's happening underneath the surface. We are now hitting correction territory, and correction territory is when the market sells off between 10 and 20%. Well, guess what? The S&P 500 is down over 10 as of Friday. The NASDAQ's down over 11.7, and small caps are actually nearing bear market territory since July 31st, here down 17%. So we've got to keep that in mind. We got to look at that. That's why we're in protect mode. Don't know where it's going to end up, but let's go ahead and wait till we see that trend change before we start diving back into equities. All right, another big mover from last week was GDP came out, and it came out and blew away everyone's estimates and came in at 4.9 for the third quarter. Okay, and that came from 3 areas of acceleration, and I'm going to go over those. One was consumer spending, which makes sense. Consumers are still spending, but not only that, it's going up because inflation, so the cost of everything has gone up. So that has gone into the GDP number. Private inventory investment. Inventories are going up, and this is a seasonal adjustment that usually happens between the third and the fourth quarter to ramp up, hopefully, for a great Christmas season. So that's another one. And then federal government spending, which I've been going over for the chart of the week, for each week. The government is spending like they were spending in COVID. A lot of that has to do with the war. and to prop up, try to keep this market and economy up. So those three things, take those out, we're probably in the 1% to 2% range. So we'll anticipate that next quarter we'll see a drop in GDP. All right, the number three is Bitcoin. We did have a rally in cryptocurrencies, and Bitcoin was one that surged for the second week in a row, and it gained about 25% over the last couple weeks. And on Friday, it was trading around 33.9 after having reached the year-to-date high of 35,000. Again, it was up in the 69,000s before, but year-to-date we're at 35. And yes, we do own this in our portfolios for our existing clients a little bit. All right, let's go over the top 10 asset classes, performance, and positioning for our asset classes, and no changes this week on a short-term basis and intermediate-term basis. We are bullish on the US dollar, gold, and commodities, and we're bearish on the bonds, the equities, and real estate. All right, let's go over the top three market movers for this week. On Tuesday, Wednesday, the FOMC is meeting. And Wednesday, they will come out with their interest rate decision. And right now, there's a 98% chance they're going to do nothing. They're going to stay put and keep it in the 5.25 to 5.5 range. So anticipate not a lot of action, but they will be listening to what Fed Chairman Powell is saying and parsing every single word. So, but there are some other central banks, Bank of Japan, Bank of England will also be announcing or setting their interest rates. So we'll have to keep an eye on that just in case there's anything that happens overseas. Number two is we get a lot of jobs data. On Wednesday, we get JOLTS, and then we get the ADP employment report, which goes over the private sector. But the big number will be on Friday when we get the non-farm payrolls, and it's projected to come in at 170. And last month, we had that big jobs number, 336, as I said earlier. So anticipate, the takeaway here is they'll anticipate that they're going to probably revise those numbers down, but everyone's waiting for the jobs numbers to start coming down. But we are in such a tight labor market, and it's very difficult to find good help, and people have 2 to 3 jobs. So, it's not coming down as fast as everyone's thinking it. All right, the number three is another big week of earnings. We get McDonald's. We get a lot of companies coming out. They're all listed here, name and picture, but the big day will probably be on Thursday when we get Eli Lilly, couple oil companies, Starbucks, and then the big tech giant Apple. And typically as Apple goes, so goes the market. So big tech did not produce last week. So can Apple save not only the tech sector, but possibly the market? We shall find out Thursday. So I think that'll be the biggest market mover of the week. All right, that's it for this week. Thank you for joining us. Our next update is Monday, November 6th. As always, continue to subscribe, like, and follow, and we shall see you next week. Have a great week trading.